Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. Of course, we had an update from the Bank of Canada. We're going to get to that, the implications of how this is going to play out on the housing market, on the mortgage market, and then what we're seeing in the data here in Vancouver, as well as we're seeing some in the GTA as well. Going to walk you through all the implications of this big announcement from the Bank of Canada. So, 2-year rate hiking cycle has officially come to an end. We get our first cut. Remember, they started hiking rates in March of 2022. So just over 2 years later, we are now into the cutting cycle. Again, I know there's a lot of, commentators here on YouTube said it couldn't happen, said it wouldn't happen. There's going to be implications. Again, the reality is this really wasn't that hard to see. The fact that we actually got to a 5% on the overnight rate without something completely blowing up is actually quite surprising. But we're starting to see that in the data. You look at the debt servicing ratio in Canada, it's currently at all-time record highs. The poison was starting to sink in. You've had real GDP on a per capita basis has been contracting. It's been contracting for 7 quarters. This is a very weak economy. You don't need an economist to come out and declare and tell you that you're in a recession. This country is already in a recession. And again, on a per capita basis, it's been in one for 7 quarters. You can see the stresses starting to emerge, particularly for small businesses, right? I mean, small businesses are kind of the backbone of the Canadian economy. Small businesses, the insolvencies have been ramping up in that space. So there's a lot of issues that, again, you're starting to see in the data, but are still working their way through the system. One of those we've talked about is the onslaught of developments, of land sites that are basically bust and just waiting to go through the litigation process and to actually end up as basically a bankruptcy. And so these are already playing out and they're going to continue. So despite the Bank of Canada cutting rates by 25 basis points, this doesn't change the math, right? I mean, if you think about it, I'll give you a very simple synopsis here. Let's just assume that you are a variable rate mortgage holder in this country. A 25 basis point cut means that for every $100,000 you borrowed, you're saving about $15 a month. That's just not going to move the needle for most people that have seen their payments jump by, thousands of dollars. So $15 a month, times it by 5, it's just not moving the needle a whole lot. And so the same thing is playing out think about a developer that's highly levered, right? They took on, floating rate debt to build a development site. A 25 basis point on, a $30 million loan, it's just not going to move the needle. So the Bank of Canada, even if they continue to cut rates later this year, the forecast, the estimate from the market is still 75 basis points a cut. So even if you get another 50 here to round out the year, it's not going to change the financial equation for the vast majority of Canadians that are stuck in difficult situations. And so, people will say, well, again, how much can the Bank of Canada cut? The Fed might not cut at all. Well, again, we've talked about this before. The release valve is the Canadian dollar. And we had Tiff Macklem reaffirm that in his press conference this week. So let's clip over to Tiff Macklem right now.
The Canadian dollar, as I said previously, we have a flexible exchange rate. And one of the ways monetary policy works is it works through the flexible exchange rate. And it's the flexible exchange rate that gives us the ability to set interest rates in Canada that are geared to the needs of the Canadian economy. So, we don't have a target for the exchange rate. We have a target for inflation. We believe in flexible exchange rates. And I think by being clear about our forecast, being clear about what's on our mind, by doing these press conferences, by publishing the monetary policy report, by providing a summary of deliberations, I think markets have a very good idea what's on our mind, and that's going to be reflected in the expected future interest rates. That's going to be expected in the exchange rate. That's monetary policy working.
So the currency, again, is going to be sacrificed at the altar. Don't be surprised to see the currency, the Canadian dollar, continue to slide lower over the coming months, particularly if the Bank of Canada moves in July and or September coming up. And so now everyone's saying, well, what does this mean for the housing market? I had all these reporters calling me, saying, hey, can you jump on an interview? Can we interview for the radio? What's going on? Housing market's going to pick up. I'm dealing with prospective buyers, sellers. Everyone's asking, what's going on with the housing market now? 25 basis points a cut. We're going to unleash the animal spirits. And like I said, I think coming into this was kind of already widely anticipated. Like at the start of the year, the expectations from markets was 6 cuts from the BOC. Again, now we're going to probably get 3 this year. That's what the markets are expecting. We just had our first cut. So it was kind of already expected. Will it shake a few people off of the sidelines and say, you know what? Yeah, I don't want to take the chance. I'd rather just get into the market now, have some peace of mind, get in. Sure. We're going to basically go from record low sales. We're going to see a bit of a bump in activity. I think that's totally reasonable to expect. But the reality is that, as I've talked about, the financial equation hasn't changed, right? So your variable rate mortgage is basically, is still at about 6% today. 5.8 to 6%. That's not a lot of relief. So again, even if you get those cuts, your variable rate mortgage by the end of this year is still going to be in the 5s, which is exactly where the fixed rate mortgage market is. And the fixed rate mortgage market is not impacted by Tiff Macklem. It's impacted by the economic data. It's impacted by global factors. It's impacted by government borrowing and debt issuance. And so the bond market is largely out of the control of Tiff Macklem at the Bank of Canada. And so this is what I really try to emphasize on these interviews on all these news stations. That, the average Canadian is getting all jazzed up thinking, hey, I'm a home seller. I'm suddenly going to get a new price because the Bank of Canada is cutting rates again. But hold on. The vast majority of the buyers are still taking fixed rate mortgages today. And those really haven't changed. I mean, a 3-year fixed rate mortgage, if you make a few phone calls and you have a decent mortgage broker, a 3-year fixed rate today is about 4.99%. So that basically really hasn't changed over the last 6 to 12 months. And so that is the reality, that nothing has really changed other than a little bit from a sentiment perspective. And so we're going to watch and see how this shapes out. There's some interesting dynamics, again, that I think are at play. We can see this in the data. So if we look at Vancouver housing data, and I know the data was very, very similar in the GTA for those that are paying attention from over on the East Coast, is if you look at the Vancouver data, home sales for the month of May, outside of May 2020, which was the depths of the pandemic. Everyone was getting locked into their houses. Everyone was scared. The world was shutting down. May 2020. This was the fewest home sales. Just this past month in May 2024 was the fewest home sales in Greater Vancouver outside of May 2020 since the year 2000. So for all intents and purposes, we have a 24-year low in home sales. So yes, they're going to pick up slightly on a little bit of a sentiment change as the Bank kind of enters their easing cycle. But mathematically, the demand is still going to be weak because rates are still basically in the 5s. And I think where you're going to see most of the issues is, again, it's going to be in the condo space, particularly where the investors are playing, because the math has not changed. The math has not changed, particularly for investors. Nothing cash flows. You're still borrowing at 5%. And if you look at it, none of these investment condos cash flow. And so we're seeing not just net sellers, people saying, you know what, I'm stuck. I can't raise my rent. The BC government says I'm capped. I cannot raise the rent. I'm renewing my mortgage, and the mortgage is now 5%. I went from cash flow neutral to losing $700 a month. I think I'm going to put this thing on the market, sell, get out. And that's the prevailing sentiment amongst the investors. Now, let's just say, even if investors were not net sellers, let's just say, everyone just kind of opts to hold on to the rental units, and just keep them, grind through this. Well, you don't have new investors buying. So investors are not out there actively purchasing. They're not actively out there making offers on properties because, again, the numbers just don't work. They don't pencil at all today. And so until either rates come down quite a bit or prices or rents go up a lot or a combination of the three, it's going to be a slow trickle getting investors back into the market. And investors have played a significant role in the condo market over the last 5, 6, 7 years. I mean, you think about it, when you could borrow at 2% and rents were rising, 8, 9% a year, it was a compelling investment, right? You could only get 0.5% in your savings account. So today you're getting 5% in a GIC and you're negative cash flowing in all these investment units. There's not a lot of incentive to go out there and purchase a 1-bedroom condo. And so you don't have net, you don't have new investors buying. If you think about like a market like downtown Vancouver, downtown Toronto, like 50% roughly of units of units in downtown Vancouver are purchased by investors, right? Like a 600 square foot 1-bedroom is quite often the buyer for that is an investor. And so again, if the math doesn't work, which I don't think it's going to work, even if the Bank of Canada cuts rates, an extra 50 basis points this year, it's not really going to change the math there. And so I still think we're dealing with a scenario where inventory could stay a bit more elevated. If we look at the number of new listings hitting the market, okay, so if you look at new listings for Greater Vancouver condos, it was the highest number of new listings outside of May 2021. Now, again, May 2021 also coincided with a huge boom in sales. So sales kind of offset the listings that were coming to market, right? Because everyone was churning over, everyone was moving, relocating. So you had sales that were coming in to soak up the number of listings coming to market. Today, that's not the case. And so outside of May 2021, it was the highest number of new listings since the year 2000. So again, for all intents and purposes, when we start to unpack this, 24-year low in sales, 24-year high in new listings, inventory is building and price pressures are building in segments of the market. So again, I really want to emphasize in segments of the market. You can't paint a broad stroke today. There's a lot that's happening. But I would say in general, that is the core thesis. So if you're asking me, what does this mean? The Bank of Canada just cut rates. What's the trajectory here moving forward? Yes, I still think rate cuts are coming. I don't think they can deviate much from the Fed. So, maybe we get another 25 or 50 basis points this year. Ultimately, how much is the bond market going to move? Because that's what's pricing fixed rates. I don't think that's going to move a whole lot. So I think we're just going to have to deal with the reality that, 4 is probably the new 2, and it's still going to be a tough adjustment for a lot of Canadians because quite simply, the core thesis of this video is the math has not yet changed. And I suspect, again, a good chart here from my friend Ben Rabideau, which shows that historically, the pain for borrowers starts after the first rate cut. So you actually tend to see mortgage delinquencies push higher after central banks start cutting rates. And the reason for that is it just takes a long time. Think how long it took for the rate cuts to kind of pass through into the Canadian economy, right? It's been like, just over 2 years. We're just now seeing like a lot of the pain from these rate cuts or from these rate hikes. We're just now seeing. So how long is it going to take? It's that delayed reaction. Like, how long is it going to take for 50 basis points, 75 basis points, 125 basis points of cuts from the Bank of Canada to actually pass through the market? That's going to take time. And so I still think we're kind of mirrored in relatively a very, very similar market. We'll have to wait and see as the data sort of progresses. But that's kind of my prognosis. So you can kind of tune out the, tens of thousands of realtors doing their TikTok videos telling you to go and buy 5 pre-sale condos because the bank just cut 25 basis points. Remember, guys, the math hasn't changed. And as always, tune into this channel. We'll try to continue to unpack it. Bullish, bearish, don't really care. Just trying to understand what's happening in the market and how it can provide the most value to you guys. And hopefully this can aid in any decision that you're making in the marketplace today. As always, hope that helped. See you next week.